Let's get June started. Live from New York City this morning. Good morning, good morning. Your equity market totally unchanged on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, the debt limit deal passing the House with ease. Some Fed officials suggest a break from rate hikes, even as the jobs data continues to come in hot. We begin with the big issue. A hop, a skip, a jump, just don't call it a pause. Investors whipsawed three different ways in the last 24 hours by more weak manufacturing data, more strong jobs data, and then by some relative Fed doves. Officials at the U.S. Central Bank debating whether to take a break from hiking. Governor Jefferson pointing out a decision to hold our policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. President Harker building on that to suggest, I'm in the camp increasingly coming into this meeting of thinking that we should skip, not pause. I don't like the word pause, but skip an increase. Any decision to pause, or should I say skip, this month is likely to be met with resistance. President Mester, one of those pushing to do more. President Bullard is another, and economists at Barclays agree. In our view, the stronger than anticipated activity revealed that monetary policy is not as restrictive as we and many FOMC participants had been expecting. The next catalyst just around the corner. In the latest read of our survey here at Bloomberg, the median estimate for payrolls is for that to come in at 195,000 tomorrow, and for unemployment to climb slightly to 3.5%. Joining us now to discuss is Kathy Jones of Charles Schwab, Mike Kontopoulos of RB Advisors. Kathy, first to you, a hop, a skip, a jump, a pause. Well, what's June going to bring?
Yeah, I think we have to listen to Jefferson and Harker on this. Came out and made it clear, not likely to hike at this meeting, but want to leave the door open to a hike next time around. And I think that that's pretty consistent with a Fed that believes it's reached at least neutral, if not restrictive level, seeing some softness in the economic data and in the inflation data, and still maybe some lagging worries about that financial instability that we experienced in the banking sector just recently. So I think it makes a pretty good case for a skip, I guess, pause, skip, hop, jump, whatever you want to call it. I think not a rate hike this time, leave the option open for down the road.
And Mike, they're going to use the most frustrating word in the Fed speak world, which is basically they're data dependent. And I sit here and I often wonder what that means. Dependent on what data? Manufacturing right now is really weak. Services are robust. You look at the labor market data, it looks really resilient. Some people might say it looks really good. Mike, what does data dependence mean?
Well, I think it comes down to labor, Jonathan, really. I mean, and we'll see what happens, of course, in the coming weeks. But you've got jobs data this Friday, and I think that's going to be the big determining factor in what they do in June. If you blow it out of the water, I don't see how you skip the June meeting. I think you have to hike. It's clear the manufacturing side of the economy is weakening. It's clear that growth is not particularly going like gangbusters here. But with that said, the service side of the economy is doing quite well. And if you look at super core inflation, I mean, it's really not going anywhere. If you look at core PC, it's bouncing between 4.6 and 4.8. And so I don't understand how the Fed, doesn't go in the June meeting. A lot, like I said, will depend on the labor market and this jobs report coming up. Of course, it's what they should do versus what they will do. Yep. I think they're probably right now tilting towards a pause of some sort, but or a skip, if you want to call it that. But I don't know if that's the right thing to do, given some of the underlying strength on the service side and the labor market.
Kathy, as you look across the economic data right now, what's on your dashboard? What do you put more weight on? What's happening in manufacturing, in services, the labor market overall?
Yeah, I mean, we look at all the overall trends, and frankly, leading indicators is a really good, simple guide to look at. And those have been declining for about a year as the Fed's been tightening. But we're also looking at the underlying wage costs. And what we saw just this morning, the revisions to the unit labor costs for the last quarter were significantly lower, and that trend is starting to come down. So the contribution to inflation is less and less coming from labor and coming from other places. And we see wholesale prices coming down. Commodity prices have been very, very weak for a while. And that's starting to that will work its way through to disinflation, we think. So we're watching the labor market, but mostly the unit labor costs and the aggregate work week, because that tells us about aggregate income, which could drive demand going forward. And then we're looking at the broader spectrum of numbers that just show just a gradual slowing in the overall pace of economic growth.
More data just around the corner. And just behind us as well, about 35 minutes ago, jobless claims coming out. Mike McKee can put all of that together for you. Hey, Mike.
It's been a very interesting morning, John, because the labor market still seems very, very strong. First off, ADP comes in much higher than anticipated at 278,000 for the month of May. And we also saw, as Kathy just mentioned, unit labor costs drop from 6.3% to 4.2% in the first quarter as productivity improved a little bit, a decline of 2.1% from 2.7%. And claims, as you mentioned, 232,000, little changed on the month. So what does that mean for tomorrow? And the payrolls numbers, we haven't had any revisions yet, but it is possible that people will start revising up their forecasts because 195 is the forecast and ADP is more than 100,000 above that. No change really in the unemployment rate, and average hourly earnings forecast to slow down a little bit, although not so much on a year-over-year basis. But here's the thing. The Fed's made a big deal about inflation coming from the labor market and how tight the labor market is. And the numbers we are seeing show a very tight labor market. JOLTS this week, over 10 million again. ADP 278, jobless claims unchanged at 232. What if we get a really strong number tomorrow? Well, we also have this study that came out from Ben Bernanke the other day that said labor market costs are not a big part of inflation, and we need to look at the supply chains, which are improving, and inflation should come down. Martin Sandbu in the Financial Times today has a really interesting column posing the question, what if Team Transitory was right?
And just got that time frame wrong, Mike. Isn't everything transitory by definition in economics?
By definition, but we had an unusual situation with the pandemic, and nobody could put a time frame on how long it would take to recover. So we still don't know, which leaves you asking the question of what data dependent means.
Mike McKee, thank you. Kathy, you've had this long-held view that we should now extend duration, stay up in quality. Let's talk about the duration piece of it. It just feels like this classic kind of risk-off move off the back of forecasting a recession, that you're looking for the risk-mitigating qualities of treasuries to perform. Is that right?
Yeah, we have been of the belief for a long time that the peak in rates and long-term rates was behind us was last fall, and that they would gradually come down as the impact of the tightening by the Fed worked its way through the system. And I think that the mitigating factor in treasuries, I think, will work in terms of diversification versus equities as we go into maybe the more traditional part of the cycle, not the post-pandemic confusion, but a more normal cyclical downturn. We look for treasuries to provide that buffer against volatility elsewhere. And I think that we also have to remember we're doing QT on top of everything else. So even though the Fed may not hike at this meeting, they're also doing quantitative tightening in the background. And that gives us another kind of instrument that they're using to slow down the economy and cool things off. So yeah, we've been in the expectation that we'll see 3.25 on 10-year treasuries by year end.
Bob Michael says 3.00 on a 10-year. Right now, 3.60. Bob Michael at JP Morgan has said it on this program. He said it earlier on Bloomberg Surveillance yesterday. Michael Kontopoulos, Bob Michael is suggesting 3% on a 10-year, recession in America and rate cuts start in September. Are you taking the other side of that?
No, definitely not. I mean, I actually tend to agree more with Kathy. We've been in the long duration camp since the third quarter of last year as well. even though inflation is not anywhere near 2%, even though the labor market is still really strong and services are strong, even though we're not in a recession, growth is slowing and inflation is slowing, and direction matters. As long as growth slows and inflation slows, you feel confident about being in long duration paper, particularly when the Fed is aggressively trying to rein in that growth and inflation. And so you get an irony of the longer the Fed stays elevated, the more it hikes, the actual more beneficial it is to the long end of the yield curve, as a harder landing will get priced in. And so we like long duration as well, but that doesn't necessarily mean we think, the Fed's going to be cutting come September, or that we're going to be in an imminent recession. In fact, I think, that's probably further than what the market expects. Maybe late this year, in the first half of 2024, we're not really sure. But, this underlying strength can't be ignored. But again, the irony of the situation is the longer things stay relatively strong, with the trajectory downward, the tighter the Fed has to be, the harder the landing later.
Mike, we used to look for credit for some kind of leading view on what was developing. I wonder if I still get that from high yield credit right now. High yield spreads look pretty well behaved, given everything that you've just said. Now, Mike, can you lift the lid on the index, get below the surface, and tell me what you're seeing develop there?
Yeah, I think credit's always the canary in the coal mine, and the equity market doesn't seem to be paying attention to it right now. And quite frankly, areas of the fixed income and credit markets, to your point, are not necessarily paying enough attention to the details. When we look at small private issuers, they're defaulting at an alarming rate at the moment. When you look at repeat filers, they've increased quite a bit as well. And so these are your weakest links, and your weakest links always go first. Your weakest small companies, private companies, tend to lead what you think are larger, well-established, well-capitalized companies in the future. And that lag time can be 12, 18 months sometimes, but it always goes with your weakest links first. And that's exactly what we're seeing this cycle. And it's not much of a surprise given where lending standards are. They're the tightest they've been outside of the global financial crisis and COVID. And so, I think this is all playing out, pretty much by the traditional playbook.
And rates could well be going higher as well at the Fed. That debate hasn't been settled. Mike, Kathy, sticking with us, your equity market. We're about 20 minutes out from the opening bell. Equities unchanged on the S&P 500 with some movers. Here's Abby.
Well, after yesterday's nearly 6% decline for NVIDIA, the worst day since late January, NVIDIA, the AI and chip maker company, it is continuing its march higher, John, up 1.2%, in part as the CEO plans to meet with China executives despite uncertainty with the U.S. C3 AI, not so much, however, down almost 20%. This as reality meets anticipation. Their forecast underwhelmed. That, of course, though, comes after a 50% rally. And then Lucid Group down about 13%. They've announced a stock offering and private placements totaling about $3 billion. Investors seem a little bit nervous by that prospect, John.
Abby, thank you. Coming up, a big win for Speaker McCarthy.
Tonight, we all made history, because this is the biggest cut and savings this Congress has ever voted for.
That bill has passed the House. It's on to the Senate.
Yeas are 314, the nays are 117. The bill is passed. Without objection, a motion to reconsider is laid on the table.
The debt limit deal passing the House with ease. Lawmakers from both parties joining to approve the bill 314 to 117.
Tonight, we all made history, because this is the biggest cut and savings this Congress has ever voted for. And we didn't do it by taking the easy way. We didn't do it by the ways that people did it in the past by just lifting it. We decided that you had to spend less, and we achieved that goal.
A win for Speaker McCarthy with just one small caveat. More Democrats backed it than Republicans. The president tweeting tonight the House took a critical step forward to prevent a first ever default and protect our country's hard-earned and historic economic recovery. The next step to get it through the Senate.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the president's desk as soon as possible.
Let's get to the Bloomberg team. Anne-Marie, Katie Lyons down in Washington, D.C. MH, let's start with you. Is that a win for Speaker McCarthy?
Well, it was a win in the sense that 2/3 of Republicans did vote for this bill. The final vote count from the Republican side was 149. He was promising about around 150. And so far, Jonathan, there hasn't been a motion to vacate. So he's keeping his job at this moment. But you mentioned a very good and important nuance. More Democrats actually signed up for this bill, backing the president, than you had Republicans signing up for this bill. So that is something you're going to see the hard right and conservatives really take aim and really trying to pinpoint and poke Speaker McCarthy that he didn't get enough of those fiscal spending cuts. And the fact is the Democrats were okay with this agreement that he struck with the president.
Katie, through the House and onto the Senate.
Yeah, and John, any bill that got 314 votes in the House is going to pass in the Senate. Really, this just becomes a question of timing. Could it pass today or tomorrow, or could we see this process drawn out if individual senators decide they want to push for politically charged amendments? And that could come from both sides of the aisle. Senator Tim Kaine of Virginia, for example, wants to put in an amendment to roll back that Mountain Valley Pipeline approval that was included in this deal. Then on the right, you have Senator Rand Paul, who wants to force a vote on an amendment to actually cut spending more. And of course, Senator Mike Lee of Utah, who has been vocally opposed to this deal, could force a vote on several amendments. So really, it just becomes a question of how long this is going to be drawn out for. Of course, Chuck Schumer, the majority leader in the Senate, has said there is very little margin, really no margin for error here, really encouraging both sides of the aisle to expedite this process as quickly as possible. But it really can just come down to one individual in the Senate because so much depends on unanimous consent. So we're going to have to wait and see how quickly they can get this done, assuming that they can do so before June 5th, the ex-date deadline, John.
Follow the money. The cash balance, $37.4 billion at the Treasury right now. AMH, they don't have time for fun and games, do they? This passes before the weekend, going into the weekend?
They don't have time. It is a little bit too light on the cash balance sheet for, I'm sure, Treasury Secretary Janet Yellen's comfort. Listen, I would look at the words of Senator Mitch McConnell. He has been doing this for decades. He says there's going to be a vote today. Yes, there might be some grandstanding and posturing, but this will get done before June 5th.
AMH, Kelly Lyons, to the two of you, thank you. Still with us, Kathy Jones, Mike Contopoulos. Kathy, first to you. We're going to have hundreds of billions of dollars of T-bills coming to market. We've done this before. It's been okay. Any reason that it won't be okay this time around?
No, I don't think so. It's going to be a little bit tricky because, you know, you've had the money market funds going to the overnight reverse repo market. And this should mean that we get some of that money moving to the T-bill market to absorb some of the pressure. But, you know, yeah, we're going to have a lot of issuance, but I don't think that there's a question that the market can absorb it. It might be a little bumpy for a while, but demand is usually just very strong for treasuries, and supply only drives yields over the very short run. I've never found supply to be the big issue over the long run.
Does it compete with banks, though, Kathy? I think is the worry here. I don't think people are too concerned about the T-bill issuance getting away. People will suck it up. It's what it takes something away from.
Yeah, I do think it takes money away from the banks. You know, the deposit rates are still pretty low. We've continued to see kind of a slow drain there. So after the big issues with Silicon Valley Bank, et cetera. So I do think it still competes with the banks. And it's one of the things the Fed does have to consider in tightening policy. You know, if they raise rates another quarter point, how much pressure does this put on the small regional banks in particular with that deposit drain? I don't think they want to go back to where we were just a few months ago and dealing with another banking crisis.
Mike, are you anticipating any problems whatsoever?
No, I generally agree with Kathy. I mean, I think the bill supply will be absorbed pretty easily. You know, and listen, you're going to get a little bit of liquidity tightening because of it. But the markets and the economy should be able to weather that, I would guess, pretty easily over the coming weeks. With regards to the regional banks and Kathy's comment on, you know, stress there and whether or not you see more deposit flight and sort of more trouble on the regional side. And listen, isn't that the whole point, really, of tightening policy? I mean, it's to tighten credit and you know, see some stress in that part of the market. And I think you have to get to that point in order to really drive down inflation. So if I'm the Fed, I actually, you know, of course you don't want to see bank failures, but you know, you actually have to be happy that your policy is having an impact.
Well, this is the dirty way of doing it. Let's put it that way. It's not a clean way of doing it. Mike, I just want to finish on the cash trap, the potential for that. You get all this T-bill issuance coming to market, some juicy yields, pick up 5%, whatever. Fed funds might go higher. I don't know. But, Mike, that's been the story the last several months. Once you're in cash, Mike, once you're in, say, T-bills for a month, 3 months. Mike, are we at that point now, that juncture where you need to start thinking about locking those rates in for a little bit longer? Do you think there's some reinvestment risk around the corner?
I mean, absolutely. Listen, cash is meant to be dated, not married. And at the end of the day, I feel like there are too many people out there who are really just sort of resting in cash at the moment. And from my point of view, they're just going to miss a bigger opportunity out there. And you can create a lot of interesting structures in fixed income that give you similar yields or even higher yields than cash yields, but with total return potential and diversification relative to the equity market and other asset classes out there. So I think it's a big mistake to be, you know, have the entire fixed income portion of a portfolio in cash. And you know, don't forget that long duration and structured credit and securitized products, et cetera, still offer really, really attractive risk return profiles for the next 12 to 18 months.
Mike, do you know how many people are going to use that line now? Financial advisors all around the country. Date cash, don't marry it. Mike Contopoulos, Kathy Jones, to the two of you, thank you. I'm going to use that line as well. Your equity market going into the opening bell about 7-8 minutes away. Equity futures just about unchanged on the S&P 500, trimming some of the gains this morning off the back of really decent ADP jobs numbers, whatever that's worth going into payrolls tomorrow. Claims a little bit lower, so equities in, yields a bit higher at the front end, dollar stronger. The euro briefly this morning, breaking 107, comes back just a touch at 107.05. We'll talk about that trade a little bit later. Coming up, the morning calls and later, closing out a wild month of May with BNP's Sam Linton-Brown. That conversation still ahead. Your opening bell about 7 minutes away. Third month of gains on the S&P 500, just about. Nothing just about it over on the NASDAQ. That was up by 8% on the NASDAQ 100 through the month of May. So equities with a lift coming into June, and the bond market yields higher through most of last month as well by about 40 basis points at the front end. Trimmed that gain closing out the month this morning. Yields back in just a touch by a couple of basis points. They were higher briefly off the back of pretty robust data in America. That's the price action. Let's get you some morning calls. Wolf Research downgrading US Steel to underperform, expecting weaker European prices to weigh on the company's outlook. Next up, RBC Capital upgrading Chevron to outperform 180 price target, saying the company can navigate volatile markets thanks to its solid balance sheet. That stock's up by 0.6%. And finally, JP Morgan downgrading target to neutral, warning of turbulent times ahead amid continuing consumer headwinds. That stock has been down for 9 consecutive sessions, and at the open, we might make that 10. Coming up, Macy's sounding the alarm on the US consumer, plus beware of the US dollar rally. We'll catch up with BNP Paribas' Sam Linton-Brown up next. Closing out May for a third month of gains. Can we make it 4 on the S&P 500, on the NASDAQ too? The NASDAQ through May up around about 8%. Monster outperformance for mega cap tech. You strip out the muscle of tech, the S&P 500 equal weight negative on the month. There's the opening bell for the month of June. Switch up the board and get to the bond market. Yields look like this. We're down now, lower, all over the place over the last 24 hours. Whipsawed by weaker manufacturing data, robust labour market data, dovish Fed speak, all relative, of course. Yields down, a break of 360, 359.88 on a US 10-year. In the FX market, closing out last month on euro dollar for the worst monthly performance on the euro side, going all the way back to spring last year. That was May for you. brutal. Dollar stronger. We'll touch on that in just a moment. Crude down for a third session, near lows we have not seen since March. A break of 68 briefly. $68 on WTI right now. Call it 67.98. More broadly, about 30 seconds into the session, your equity market slightly positive, up by 0.1% on the S&P. Similar move on the Nasdaq. One stock to watch at the opening bell. It's all about Macy's, firmly in the red after the retailer cut its full-year earnings outlook. The CEO said this: "We planned the year assuming that economic health of the consumer would be challenged, but starting in late March, demand trends within our discretionary categories weakened even further." Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, really rough reception for Macy's in the stock market right now. You can see shares down by over 5% or so. Adjusted EPS actually beat estimates, but as you pinpointed, it was all about the gloomy guidance that Macy's gave. Really, again, warning, rather. It's been a rough morning about those demand trends starting in late March. So let's get into some of the numbers here, because full year adjusted EPS, currently, they see that between $2.70 to $3.20. The previous range that they had gained had been between $3.67 and $4.11. So really lowering that range altogether. It also lowered sales guidance as well. And this was interesting. They said that they're going to need to take further markdowns to manage its excess spring inventory. We know that inventory has been a big problem for a lot of these retailers. Apparently, it's still a problem for Macy's. Currently, shares off by about 5%. That number had been down as much as 15% pre-market, John.
Tough morning for them as soon as the numbers dropped. Katie, thank you. As Katie points out, that stock a whole lot softer. Similar story over at Dollar General, slashing its annual profit forecast with shoppers facing numerous headwinds. The retailer said this: "The macroeconomic environment is more challenging than we had previously anticipated, which is having a significant impact on spending levels and behaviors." Kaylee, we're down 12% there this morning.
Yeah, the loss is just building as trading goes on for these first couple of minutes. This is actually now the worst day for this stock since August of 2016. Not only was it a disappointing first quarter, as you allude to, John, it was disappointing guidance. The company is now guiding EPS growth of between -8% to flat. They previously thought EPS would grow as much as 6%, so that is a really sizable cut. And their comp sales guidance also came down. They previously saw between 3 and 3.5%. Now they only anticipate that comp sales are going to be up by 2% max. This really is about the macroeconomic environment, as we saw in the statement. And we have to keep in mind that this company operates dollar stores. They cater to a lower end consumer, and it is in that low end that we are seeing spending and consumption patterns change, spending more on necessary items like food, less so on discretionary. And obviously this stock is feeling the pain of that. Again, we are now down more than 13%, nearly 14% in the first few minutes of trading here, John. The stock at the lowest level since May of 2020.
Wow, that looks tough. Kelly, thank you. Let's stick with retail. Target is negative for a 10th consecutive session. That is the longest losing streak going back to the year 2000. There's a lot of issues at this company right now. JP Morgan downgrading the company to neutral, pointing to numerous macro headwinds. The analyst writing this: "The backdrop for consumers has gotten worse, with market share risk rising ahead of the most important quarters of the year. As such, the prospect for additional downward earnings revisions is rising." Now, the problem we've all got this morning is this a story about Target, a story about Dollar General, a story about Macy's, or a broader story about the US consumer? Because I'm also looking at Nordstrom this morning, delivering better than expected quarterly results and reiterating its forecast, with the CEO saying this: "We're encouraged by our momentum, especially given the uncertain macroeconomic environment. We remain focused on executing with agility and delivering long-term value to our shareholders." Abby has more. Hey, Abby.
Hey, John. Well, here's something interesting. Before today, this stock, Nordstrom, was on pace for its 9th year down in a row, sort of reiterating these bearish trends that you're talking about. But because of today's gain, it is now higher for the first time on the year since 2014. Of course, the year is young, but this comes as the company puts up a surprise profit of 7 cents versus an expected loss of 13 cents. And apparently has everything to do with the Nordstrom rack. The gross margins are moving in the right direction there. Apparently, the improved premium brand assortment mix is really helping out. Prior, that had weighed on the stock. And a lot of analysts out there, John, think that it's only going to get better for Nordstrom, that the second half will be stronger. So this divergence between the haves, the have-nots, the low-end consumer, the middle consumer, the high-end consumer continues. But Nordstrom analysts seem positive that they are moving in the right direction.
Stock up 5%. Abby, thank you. It's the story of the moment. Pick a data point, pick a retailer and confirm your priors. Pick a retailer right now. You bullish? I'll find one for you. Bearish? Plenty out there this morning. Nordstrom up by about 5%. Let's get to some earnings from the cloud space this morning. Salesforce under pressure after reporting a disappointing outlook. The company forecasting slower growth as it shifts its focus to generating higher profits. Alex Webb has more for us this morning. Morning, Alex.
Yeah, it's a tough morning for Salesforce shares. The company reporting not only a full-year outlook that was kind of in line with expectations, but also the current quarter just shy of expectations. Essentially, its order book is going to grow by 10%. The market had been looking for about 11%. Clearly not a massive miss, but it's to do with the way this company is changing essentially its equity story. It had an activist investor come in last year saying, please focus on profitability. For a company that for much of the past decade has been your classic growth stock, reinvesting its profits into gaining market share. Now we've seen the earnings come up, the profitability really start to come up. That has brought down the price to forward earnings ratio. But the management has a reputation for being particularly conservative and at times then boosting those outlooks for the full year. That has not happened this time around, and the stock is being punished as a consequence.
Down 6%. Alex Webb, thanks for that. That's the earnings wrap. We're starting the month of June, 6 minutes into it, and we're lower by 0.1% on the S&P, on the Nasdaq, down by 0.2%. We've closed out a crazy month of May. The scores are in. The S&P 500 just about squeezing out a month of gains as the Nasdaq 100 climbs almost 8%. Nvidia adding some serious weight, a 36% rally last month, leading to a gain of almost $250 billion. Jim Reed of Deutsche Bank summing it up nicely. A month that felt like a year. Starting off with the closure of First Republic Bank, we then had another set of rate hikes from the Fed, the ECB, negotiations around the US debt ceiling, serious excitement about AI, along with some increasingly downbeat data outside of the United States. That downbeat data outside of America upending another consensus trade, helping to drive some dollar strength and sending the euro to its worst month in more than a year. Joining us now to discuss is BNP's Sam Linton-Brown. Sam, wonderful to catch up with you, sir. I just want to reflect on that dollar outperformance, that dollar strength last month. Was that down to resilient US data or just bad data elsewhere?
Good morning, John. I think it was down to the upside surprise we had in US activity versus the downside surprises that we were getting in both the Eurozone and China. At the same time, we also had some continued sort of calming down, alleviation of banking stress across US regionals that prompted the market to price out some of the aggressive cuts that were discounted. So I believe you had a repricing both in terms of US growth versus rest of world and US yields versus rest of world that triggered an unwind of what had become a very large consensus dollar short position. Our view from here is that the dollar does have some scope to rally, but only selectively and only moderately. So we like dollar CNH higher. We think that pair can go to 720. A lot of that's to do with our China view. And we also think the pound is far too strong here. We think cable's rallying on some temporary rebalancing flow and that it's an attractive sell around current levels at 125, looking for a move to 120.
Sam, let's talk about China just briefly. I think people are sort of scrambling, trying to find new engines for dollar weakness. You can't reopen twice in China. Where's the potential that it comes from anywhere right now?
A lot of pessimism is already discounted. If you look, for example, at 5-year interest rate swaps in China or non-deliverable interest rate swaps, we hit 3% in January. We're now beneath 2.5%, essentially at the same level we were prior to reopening. I think what we've seen and what's being borne out in the China data is that unlike developed markets, reopening hasn't been non-linear, or exponential, if you like. It's been more of a linear process. And that's what our view has been. That's what our view continues to be. We think that sentiment probably at this level, in terms of Chinese assets, has got a bit on the pessimistic side. Like I said, in FX, we think there's some further weakness still to come. But on rates, we wouldn't be wanting to receive rates in China here. What could be the catalyst for a change in sentiment? I think it probably will come from some policy stimulus that could be announced out of China, perhaps at some point early in H2.
How targeted do you think that stimulus might be? What's the character of that stimulus? What does that look like, Sam?
I think in practice, the impact it has may not be that large on the economy. But given that the markets price so pessimistically, a bit like we saw at the last Party Congress in November, I think it can provide a pretty significant trigger for an improvement in sentiment across China growth correlated assets like base metals, like G10 commodity exporters.
Yeah.
That have really been beaten up by how pessimistic the market is there.
You mentioned how pessimistic and the pessimism we had discounted in some of these markets. Sam, going into the winter last year, clearly peak pessimism around Europe. Clean break of parity. I think we were down at something like 95, anticipating the worst for winter, bailed out by the weather and a reopening in China. Here we are resetting at about 107. Sam, from here, the conversations I had to start off the year were all about the ECB hiking more than the Federal Reserve. And Sam, you and the team at BNP approach this and tackle this question slightly differently. You think it's going to be all about the cumulative tightening that's already in the pipeline and that damage is done that's done as a consequence of that. Sam, what does that mean? Because from my perspective, that might mean the US surprising even more because it proves to be more resilient, stand up to those hikes even more than perhaps Europe can. What's your take?
The US economy's held up better than I believe the market had expected, given the tightening that's been delivered. And that's prompted investors to question, is policy transmission broken? Or are there some buffers that exist which have delayed the severity of that transmission? But once those buffers are used up, then we'll see the impact on the economy. We're very much in that latter camp. We think the US economy will enter a recession this year. We think it will occur in Q3. We're not talking about a very deep recession here, but nonetheless one that's consistent with the Federal Reserve having already delivered enough tightening.
Let's build on that from the equity side, Sam, if we can, just quickly. I do want to get your view on where you take that equity risk. Where would it be? The US versus Europe, with everything in mind that you've just said?
The view prior to the recent AI news flow felt more compelling for secular underperformance of Europe that had been so evident over the past decade to partially unwind. And I think that view, while the recent news flow challenges it somewhat, is still the right one to hold. The US is where policy tightening started first. It's where policy tightening has been most aggressive. It's where liquidity is going to contract, that I think is really a key topic that perhaps we should discuss most significantly. And our view is therefore that that's the market where you'll see the stress occur first. US cyclicals, as you pointed out just before this segment, have been performing very poorly. So the lack of breadth in the US market gives us some concern, even though at an index level it's been stable. So we'd favor Europe over the US as a bias.
I know you liked the banks for a long time, Sam, particularly in Europe. It was a great call last summer. It paid off in a big way. Is it still the case that you like the banks in Europe?
Less so than before, but on net, yes. We think they will outperform in an overall bearish market backdrop.
Sam Linton-Brown, we've got to leave it there of BNP Paribas. Thank you, sir. Wonderful to catch up about 13 minutes into the session. They still like Europe. The place to be right now, as you know, over the last month, US big cap tech, without a doubt, given what's happened with NVIDIA. Right now, about 13 minutes in, we are negative by 0.1% on the S&P, on the NASDAQ, totally unchanged. Coming up, investors gearing up for another big payrolls report.
We still think we're going to be in recession by the end of the year. I think the Fed's got this wrong.
Plus another batch of fresh economic data on deck. The difference between robust services data and dreadful manufacturing data up next.
We still think we're going to be in recession by the end of the year. Everything that's happened so far this year continues to tell us end of the year recession and first Fed rate cut in September. And I know the recent data throws some of that into speculation. Not in our book. Things are playing out the way they should exactly. I do think inflation is going to fall off a cliff here, and I think the Fed's got this wrong.
Bob Michael at JP Morgan predicting an economic downturn and rate cuts by September. Neil Dutter of Renaissance Macro remains optimistic. He says this: the main reason for his optimism on the US economy is that inflation, especially prices for commodities, is easing more rapidly than the labour market. As a result, real incomes will expand, supporting consumption. Now, as I've said repeatedly through this morning, right now you can pick a data point and tell any story you like. The latest services data supports the view that the economic expansion is still on course. The latest manufacturing data worldwide, China, Europe, or the US for that matter, is screaming cut rates now. How that spread closes holds the key to settling a big debate. Just how close are we to that elusive recession? With the latest data, let's get to Mike McKee. Hey, Mike.
Hi, John. I wish I could give you a good answer. We've been 3 months away from a recession for about 2 years now, according to all the predictions. Now, we do get manufacturing numbers today that should tell us something more about the factory sector. We got the S&P Global U.S. Manufacturing PMI just a few moments ago, and it is a little changed at 48.4, down from 48.5. Statistically irrelevant. It does suggest that manufacturing is still contracting. But what does that tell us about the economy? ADP earlier today, 278,000 jobs, and they said manufacturing lost 48,000 jobs. Now, last month, ADP said we lost 30,000 jobs, and the non-farm payrolls came in with 11,000 additional manufacturing workers. So it's really hard to get a read on where we are with all this. Now, we do get the ISM at the top of the hour, John, and everybody's going to be looking at that, both for two things. We want to see what the employment number is. Last month, it was 50.2, but everybody's going to want to see what prices paid are. If Neil Dutt is right, then prices paid should go down. They are at 52.3. Is the forecast. After 53.2, they went up a little bit last month. If that comes back down again, then that helps make Neil's case.
Mike, how do you read this? Does manufacturing pull services down, or does services pull manufacturing up? How do you think about that?
Well, services, in a sense, should pull manufacturing up if they stay strong and there's a lot of hiring, because those people have money and they will be buying things. We've had this imbalance between goods and services for quite some time because people could only basically buy goods during the pandemic. At some point, that has to even out a little bit. We had a big drop in goods purchases, and we saw inventories go away, and manufacturing has been in a slump. But that may have to start to come back up again as people continue to spend and use up all the services that they had a backlog of demand for.
Mike, we've seen this movie before, haven't we? Do you remember the end of 2015? All that China weakness, the worries about recession there, and we had the PMIs drop sub 50. There was talk of a manufacturing recession bleeding into the broader economy. I feel like we did that for years, Mike, and escaped it. Is this any different?
Well, it's hard to say that it is different because, of course, you're not supposed to say that. But the problem is we don't know from the pandemic situation. It has distorted so much in the economy. It doesn't seem like there is a nationwide weakness in manufacturing in the same sense that there was in 2015. It does seem that there has been a shift away from buying stuff, and companies have produced less, but they haven't hired fewer people, and they haven't let people go in big numbers in manufacturing. So it's hard to get a read on how broad this is and how long it's going to last.
Payrolls data coming up tomorrow. Mike McKee, thank you. Just to bring you the estimates right now, for those of you just tuning in our Bloomberg survey, gets updated frequently. 195 is the median estimate so far, 195,000, down from 253K. Every single Payrolls Friday that Mike McKee has been doing over the last 12 months plus, on the day that number drops, it has beaten expectations going all the way back to last spring. In April, for that matter, looking back at the March payrolls report, is it any different tomorrow morning? 195 the estimate for payrolls. For unemployment, looking for that to climb from 3.4% to 3.5%. Before we get there in about 8 minutes, Alex Still is going to run you through the ISM manufacturing number. Expectation for that is 47, still sub 50. At 47. Contraction rate, we're seeing that elsewhere too, in Europe, in China, and as we pointed out, in services, you do not see that. The data so far this morning, pretty robust. The ADP report, big upside surprise, 278. We were looking for 170. Jobless claims coming in at 232. The estimate there about 235. So in and around 230K now for the last couple of weeks. Pretty solid data, and we're talking about a skip, not a pause, at the Federal Reserve. Let's get you some price action for the month of June. About 20 minutes into this session, equity slightly negative. Abby has the sector price action. Hey, Abby.
Hey, John. Well, that small decline right now is on below average volume, and we not surprisingly have more sectors lower than not, but not too much drama here. You have communication services up the most, up 0.7%. At this point, utilities and real estate both down the most. Utilities down 1%, even as yields are lower, so defense not wanted. What's super interesting, though, is over the last month, take a look at this divergence. This is really the year of divergences. Tech up 9%. 9%. Energy down almost 10%. That was the worst month in May for energy in about a year. Tech at its highs had been on pace for its best month in a year. These conundrums, John, they continue.
Abby, thank you. There are many. Your trading diary coming up next. This is how we kick off the month of June. Slightly negative on the S&P and slightly positive on the Nasdaq. I guess on the Nasdaq, it's as you were. That's the price section. Here's the trading diary coming up shortly. Top of the hour, ISM manufacturing numbers. Philadelphia Fed President Patrick Harker speaking again at 1 p.m. Eastern. Plus, earnings from Broadcom after the closing bell. Rounding out the week with the big one. Payrolls Friday coming up on Friday. And finally, of course, going into the weekend, looking for a Senate vote on the debt ceiling bill. Tomorrow, fantastic lineup for you. Mohammed Al-Arian alongside Rick Reeder at BlackRock. iCapital's Anastasia Amoroso. PGIM's Mike Collins. Looking forward to that coverage with you. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.